Hello, class, and welcome to this chapter one lecture video. Let's get right into it. We got a lot to cover here. First, let me share my screen with you, and we'll get right into learning some accounting. All right, so yes, this is financial accounting, the cornerstone of business decision making. All right, and we'll be doing chapter one, accounting annual financial statements. So what we're going to learn here in this first chapter, okay, we want to learn basically what accounting is. You know, why are you taking this course? Hopefully most of you are business majors, maybe some are business ag majors. Maybe somebody's just taking it as an elective, but we want to explain to you what accounting is, the different types of businesses we could have, relationships from the accounting equation, maybe how this information is useful. And then we're going to learn how to prepare some basic financial statements, such as the classified balance sheet, an income statement, retained earnings statement, statement of cash flows. Okay, and then we're going to talk a little bit about ethics, and that's going to cover chapter one. We're going to do just some basic information here. When we think about accounting, what we're doing is we're going to provide some information. So the icebreaker here says when you have a medical condition, who is going to use that information? You can think a lot of people are going to use that, the doctors, the nurses, maybe the insurance company. Okay. Many people go into keeping you healthy. Well, similarly, who uses financial information? Okay. There is tons of people that want to know the financial information of the company. There's people who invest in the company. Okay, whether you want to buy stocks in the company, or you want to become a creditor of the company and buy bonds, stuff like that. Maybe a bank wants to loan some money. They're going to want to see what the financial position is. And then from a regulatory standpoint, you think about it, if you're a publicly traded company, the Securities and Exchange Commission, the SEC, they're going to want to make sure that you're not misleading your investors. So they're going to want to see your financial information. The IRS is definitely going to want to know your financial information in order to pay taxes on it. Well, how do they get that information? They get it through accounting. Why is accounting important? You can see here, I have this highlighted, definition of accounting. Okay, if you take nothing else away from this class, well, you're going to take a lot away from this class, hopefully. But if you take nothing else away from this class, I hope you get this definition here. Accounting is an information system that identifies, measures, records, and communicates financial information about a company's business activities, so decision makers can make decisions, so people can make decisions. Data is the language of business. It's a famous quote that's kind of attributed to Warren Buffett. Okay, everybody knows about that. Whenever you are talking about a business, you're talking about a financial situation, you're going to be using accounting talk. That's why a lot of students, when they get ready to come into accounting, they seem to tell me, man, I'm not looking forward to this class at all. You know, I'm not good at math. I don't like doing math. Well, the good news is there's not a lot of hard math in this class. I mean, all you basically are going to have to do is add and subtract. Maybe sometimes we're going to multiply a few things, but you're always going to have a calculator, so you're not going to have to be that great at math. But the bad thing is it's harder than that. It's because it's like you're learning a whole new language now, okay? We're going to learn how to speak in a business language. Okay, let's go back to this definition here, where accounting is an information system that identifies. Okay, that's what we're going to spend a lot of time here in chapter one doing. So we got to identify, you know, do we have a business transaction that deals with money? What is it really dealing with? Are we going to owe somebody else money? Is this business money belong to the owner? If we spent money, stuff like that. Measuring. So that is basically determining the amount. Recording, that's putting it down on paper, or nowadays more likely into some kind of computer software program. Okay. So the measuring and the recording, that is kind of the heart of accounting. And that's what we're going to get into later in the semester. And that's what we're going to be doing a lot of. We're going to measure and record. Okay. And then finally, communication. We're going to communicate all this information through our 4 basic financial statements, which we are going to conclude this chapter with. Okay. So once again, I cannot stress enough, you're probably going to see this on your exam. You're probably going to have this on your final. You need to know accounting is an information system that identifies, measures, records, and communicates financial information about a company's business activities to make decisions. So people can make decisions. There's 2 major different types of accountants. Okay, there's financial accountants and there's managerial accountants. The major differences in this is who is going to use the information that is provided. Okay, this class is an introduction to financial accounting. Okay, so for that, the users are going to be the investors and the creditors. Do people want to invest in your company? Do they want to buy stock? Do they want to contribute, become a partner in your company? And creditors, the people that are borrowing or loaning the company money. Okay, they are going to use the financial accounting information, which is what this class is. The second type of accounts are managerial accountants. They work with inside a business, so and the information they provide, so the managers can make decisions. How can we cut our costs? What should we charge for this item in order to make the profit that we're wanting to make? Okay, how much do our products cost? How do we assign all these costs to different products? We're not going to touch on that in this class. That is going to be when you take accounting 2, we will go over managerial accounting. And whether you're a financial accountant or a managerial accountant, you may find yourself one day working in one of these types of businesses. The sole proprietorship, that means it just has one owner. Okay. Great thing about that is you get to be your own boss. Okay, set your own hours, you do what you want to do, it's easily informed, you get some tax advantages and stuff like that. But it does have some negative sides. There is a personal liability involved when you are a sole proprietor. If you were to be on your own and you have a construction company and one of your jobs goes bad, okay, not only can that person sue your business for what they have, if the damages are high enough, they can come off after your own personal assets as well, own stuff that you own. They can come possibly take your house, stuff like that. And it has a limited life. Unless you pass it on to your children, most of the time a sole proprietorship, as soon as the owner is done with the business ends. Then there's a partnership. It's kind of the same as a sole proprietorship and the fact that you're personally liable. Okay. But this is when 2 or more people come together. So instead of just having one owner, now you have a couple owners, 2, 3, 4 owners. So the advantages here, you can access the resources of your other partners. Okay, so maybe you have some more money coming in to start up the businesses. And as a sole proprietorship and partnership, there's definitely tax advantages because everything that the business makes gets passed on to the owners and they put on their own personal income taxes. Beyond that is a corporation. Corporations are formally formed. Okay, you have to go through an articles of incorporation. You have to pick a state to be incorporated in. Okay, your name has to end in be incorporated. Okay, somewhere along those lines. I hope my video and everything is going good. Yeah. And so as a corporation, it's easier to raise money. You can obviously, then you can issue stocks. Okay, with sole proprietorship and the partnership, they don't have stocks. You can issue bonds. You can get out in the public and raise money from the public. It's easy to transfer ownership because we're going to learn stocks are a form of ownership in a company. And there's limited liability. You buy stock in a company and you become an owner and somebody wants to sue that company, they can't come after your personal stuff. A corporation is considered its own legal entity. Okay. The disadvantage of that is it's very complex and costly to organize and form a corporation, and there's higher taxes. Corporations typically pay a higher tax rate than a normal person. And then when the end of the year, if the corporation decides to give back some of the money back to its owners, which is going to be called dividends, we'll learn about those a little bit later. They are going to get taxed too. And so not only does the corporation pay its own taxes, it has to pay taxes on all the income, unlike the partnership and the sole proprietorship, where that just, all the income passes down out of the business to the owners, and then they pay personal income tax on it. Corporation pays a corporate income tax, and then any money they give to the owners, they pay personal income tax on as well. Oh, I love it when things don't want to work right. There we go. So knowledge check here. We have these throughout the slides. All the following are advantages of a corporation form of business, except A, a greater potential to raise money. That is true, but it is definitely an advantage. Less legal liabilities for owners. That is true. That's definitely an advantage. Greater ease of transferability of ownership through stocks. That is true. Definitely advantage, and greater taxation. That is also true. So all of those are true statements about a corporation. However, greater taxation is the only one that is not an advantage. There it explains there again what I was saying. The corporate income tax rate is higher than most personal ones, most personal income tax rates. And then when that gets passed on, when the company decides to get some money back to the owners, it gets taxed again, known as double taxation. Okay, learning objective 2. What kind of business activities are there out there? So there's 3 main types of business activities. There's investing activities, financing activities, and operating activities. It's going to be important for us to distinguish when we're identifying what's going on, what kind of activity do we have? Okay, so our operating activities. Operating activities come from the day-to-day operations of the business, whatever's going on. Okay, so we have revenues here. Revenues are the value that is received whenever we sell a product or provide a service. Okay, they're calling it the increase in assets. I like to call it the value that is received, whether it would be cash received. Okay, maybe we send out a bill with a cash amount on it, that is still value received. Or maybe somebody gives us a piece of equipment or gives us a vehicle or something like that. Whenever we perform a service for it, whatever the value of that piece of equipment or vehicle is, that would be considered a revenue. Okay, expenses are the cost of doing business, the ordinary cost of doing business. So if you think about any type of business, what kind of costs might they have? Okay, well, you got to pay your workers. And so there's a cost. You might have to buy your inventory. There's a cost. Okay, if you have some supplies that you need, okay, rent on your warehouse or your shop space. All these are normal expenses for the cost of doing businesses. Okay, revenues minus expenses get us to our net income, which we are going to do in the income statement later. So anything that's going to go onto our income statement can be considered an operating activity. Second, we have investing activities. Most people, when they think of investing, they think of taking their money, putting it in the bank, or going to the stock market or stuff like that. It's a little bit different for businesses. When we're talking about investing activities, we're talking about investing in the company by buying stuff that is going to last the company a long time. So if they went out and bought that equipment or that truck that they needed, they would be investing in their own business. They would be buying assets that will help the company in the future. Financing activities is where a company or a corporation is going to go out and raise money so that they can operate, so they have enough cash flow in order to operate. Okay, they do that by selling their stocks or by issuing bonds, stuff like that. And when they give money back to their shareholders, which is called paying out dividends, that is also a financing activity. Okay, the financing activities gets the money necessary for a company to be ready to do business. Okay, so which type of activities include the profit activities of an organization? Remember, profit is our revenues minus expenses. Anything that is a revenue or an expense in order to create a profit goes on our income statement. An income statement, these activities are known as operating activities. So here's our knowledge check number, knowledge or learning outcome number 2 there. Try to be able to identify which type of activities. Next, we have our 4 financial statements. Okay, there's 4 basic financial statements that a company must prepare. Okay, the first financial statement is the balance sheet. Okay, the balance sheet is going to show everything that a company owns at a point in time. It is just a snapshot in time of what the company owns or uses, which is known as its assets. And then how did they get those assets? Is it because the owners own those assets or bought those assets with their own money and that's how they got into business? Or is somebody else? Do we have to borrow money? Do we owe somebody else for it? Okay, claims against the resources. When we owe somebody, that would be liability. And when the owners put their own money into the company, that is known as equity. Okay, and we're going to go through and we're going to hopefully kind of explain. We're just giving a quick overview right here. Next is the income statement, which I've already mentioned. That is all our revenues minus all of our expenses in order to find a net profit. Third is retained earnings. What retained earnings is when a company makes a profit and they don't give it back to their owners, it stays in an account called retained earnings. That's the accumulated net income that a company, a corporation has had over its life. Okay. Whenever they give money back to the shareholders, they take it out as dividends. So you can think of retained earnings as accumulated income minus dividends. And finally, the statement of cash flows is just showing how the cash has changed over a period. Okay, and that is one that we are not actually going to talk about in this class. Statement of cash flows is going to be discussed when you get into accounting 2 and into managerial accounting. So just kind of give us an idea of how these kind of all work together. Remember, I told you a balance sheet is just a snapshot in time. So when we look here at our little timeline here, so maybe on December 31st or January 1st of year 1, we have a balance sheet. It lists all our assets, everything we own, all our liabilities, which is everything we owe, and all of our equity, everything the owners own of the company. And it just lists a total amount at that point in time. Okay. Throughout the year, the company is going to make income. That is going to go on the income statement. From the income statement, then we can make a retained earnings statement. Remember, retained earnings is accumulating that income minus the dividends. Okay. If we do that, we could have made if we're going to do it, we make a statement of cash flows. And then when we get to the end of the period, then we make a balance sheet at the end of the period. The income statement and the retained earnings statement are what is going to change what appears on our balance sheet. So which of the following is false regarding the balance sheet? A, the accounts shown on a balance sheet represent the basic accounting equation for a particular business entity. Well, that is actually a true statement. So we're going to get to the accounting equation, our very next thing. Okay, and then it says the retained earnings balance shown on the balance sheet must agree with the ending retained earnings shown on the statement of retained earnings. That is also true because that retained earnings was done as a period statement in there. So when we get to the end of the period, whatever our retained earnings statement shows must go on our balance sheet. The balance sheet reports the changes in the specific account balances over a period of time. That is what is false because D, the balance sheet reports the amount of assets, liabilities, stockholders, equity of an accounting entity at a point in time, not over a period of time. So your answer here is C, that statement is false. It is not doesn't show the changes over a period of time. It shows the balance at a point in time. Now, all these companies are making these statements, okay? There is a common set of rules that must be used in order to make these financial statements, okay? So that way they can all be uniform, so people know when they're looking at a financial statement, they know that what company A has done is the same as what company B has done. There can be no discrepancies. The rules that are used in making these balance sheet, the income statement, the retained earnings, the cash flows, and even when we go to record stuff, there's gonna be rules we're gonna have to follow. Those are called the generally accepted accounting principles. Okay, or in accounting world, you will commonly hear them referred to as US GAAP. Okay, US GAAP, the generally accepted accounting principles, are created then on the bottom there by the FASB, which is the Financial Accounting Standards Board. Or commonly, they like to use acronyms, so they call it the FASB. Okay, important to note that the FASB is not a government agency. It is a private agency built up, and the people that run FASB are some of the CEOs of top companies, the lead partners in the accounting firms, some of the highest accounting firms in the country, and stuff like that. And they set the US GAAP. That is only what is used in the United States, okay? So each country kind of has its own set of rules, although internationally, there's what is known as IFRS, the International Financial Reporting Standards. The European Union requires that. And a lot of other countries, although they make their own accounting rules, they are loosely based on IFRS. Okay, so it's good to know that not all accounting from all over the world is done exactly the same. So that can make it a little bit tricky when you're looking to invest overseas and stuff like that. But every company located within the United States uses US GAAP, which is set by FASB. And then the SEC, that's the Securities and Exchange Commission, that is a government agency. They're the ones that are in charge of enforcing the rules for publicly traded corporations. And all this is done so everybody can be on the same level playing field. All right, now, the golden rule of accounting. We mentioned this whenever we had our balance sheet. Okay. Our balance sheet lists all of our assets. Okay, assets, the economic resources, things the company owns. It must equal our liabilities. Our liabilities are things the company owes. Liabilities plus the stockholders' equity, which is what the owner controls or owns. Okay, so the fundamental accounting equation is assets equals liability plus stockholders' equity. Okay, hopefully we can burn that into your brain, because as we're doing everything, we always have to stay in balance. Okay, when we're measuring stuff, when we're recording stuff, when we're communicating stuff, we always have to keep this equation in mind to make sure we're doing it properly. Let's give an example of how it works here. It says on January 1st, Gundram Company reports assets of $125,000 and liabilities of $75,000. Anyway, I get those little messages up there telling me my speaker's changed. I hope you guys are able to hear me okay as I'm talking. So Gundram Company reported assets of $125,000 and liabilities of $75,000. That's January 1st. So let's go to required number 1. What is the amount reported for stockholders' equity on January 1st? When we look at our solution here, if we use our fundamental accounting equation, where assets must equal liabilities plus stockholder equity, we have $125,000 in assets. It equals the $75,000 in liabilities plus equity, which is not given to us. You just do some basic algebra there. You can find out that $50,000 has to be the equity amount in order to make the accounting equation true. For part two, it says during the year, assets increased by 44,000, and stockholders' equity increased by 15,000. So what happened to our liabilities? Well, if we plug those into the accounting equation, we can see that our assets now become 169,000, whereas our equity now becomes 65,000. Okay. So if we have 100, plug that into your accounting equation then, and then again, you can just do some simple algebra there to determine that our liabilities come out to $104,000. And you're going to see some questions like this on your homework. Knowing that accounting equation, how they interact with each other. All right, so now the classified balance sheet. The classified balance sheet, as was kind of mentioned earlier, is going to display that accounting equation to show what does the company have, its assets. Assets are, it shows what the company has, how they were attained, how did the company get it, okay? And will the company be able to pay its obligations? That's the usefulness of the balance sheet. Remember, it is just a snapshot in time. As soon as the business starts up operations, then the amount of assets and all that stuff could change the very next day. So it's a good statement to use, but it does have some limitations. Okay. So we need to talk about what this is. What are assets? Assets. Resources that a company owns or controls that will produce an economic benefit in the future. Okay. There are different types of assets. There are current assets, and then there are non-current assets. Current assets is stuff that we own or control that we expect to use throughout the year. So we're going through and we're starting to identify these business transactions. The first thing we have to identify is what actually are we dealing with, okay? So we need to know that all assets go on the balance sheet, not the income statement, okay? And what are our assets? Well, our current assets, cash. Cash is something we own or control that can provide an economic benefit. You think, you know, you got to have cash to make cash. Second, we have some short-term investments. Okay, that is also a current asset. Short-term investments is maybe we go out and invest in a company, we buy stocks or bonds in another company, and we expect to sell them right away at a quick turnaround and make a profit. Accounts receivable. This is a big current asset. Accounts receivable is when somebody owes us money, owes the corporation or the company money. Okay. Maybe we sold to them on credit, sold them something on credit. They said, we'll pay you later. Okay. That becomes an accounts receivable. Somebody's promised to pay us. Inventories are a current asset. Inventories are stuff, obviously, that we are holding, goods that we have bought, that we are holding on to resell. Supplies is stuff we bought in order to either make a sale or provide a service. Okay. You think about what kind of supplies does the company need, okay? If you're a restaurant industry, some of your supplies you're going to need. And you're going to need some pens. Okay. You need some soap to wash the dishes. You need some floor cleaner to clean the floors, stuff like that. Those are all supplies of the business, not stuff you buy to help you generate your profit, but you're not reselling it to the customer. And finally, we have prepaid expenses, our current asset. Okay. Prepaid expenses are when we pay in advance for something. This is most commonly done, maybe the rent, Maybe the company decides to pay 6 months of rent at the beginning of the year. Well, that becomes a prepaid expense, or they pay for an insurance policy for a whole year. That becomes a prepaid expense. Something that they pay for now that they're going to use later in order to make a profit. Second, there are non-current assets. Non-current assets, here we have some investments that we used. Going with technology here. So long-term investments, you buy stocks or bonds in other companies. But you plan to hold on to them for a long time. That would be an investment. Property, plant, and equipment. Those are long-term assets. That's the land, buildings, equipment that a company has that they want to hold on to for long-term use. Our intangible assets, those are things that a company owns or controls that they cannot touch. These are things like patents, trademarks, copyrights. They're very helpful for a business. Okay. There's also a thing called goodwill, which we're going to do later. And then there's kind of an other category. And we're not going to touch much on the other category because when we start talking about other comprehensive income and stuff that's beyond the scope of this class. Okay. So what are liabilities? Liabilities are things we owe to other people. Okay. There are current liabilities, just like current assets. Current assets are expected to be turned into cash or used within a year. Or current liabilities are things we owe that we expect to pay within a year. Okay. Things here, your most common one is going to be an accounts payable. That's when you buy something from someone else, whether it be inventory or supplies, and you promise to pay them later. Okay, it's kind of the opposite here of an accounts receivable. Accounts receivable, somebody's promising to pay us, so we make it an accounts receivable. And accounts payable, we're promising to pay them at a later date. Other kind of current liabilities are going to pay with the year, maybe salaries payable. Okay, we record sometimes that as a payable because they were going to pay a reporting period. We got to report stuff. Period ends. We still owe some salaries that we're never going to pay in a day or two. Employees are definitely not going to wait more than a year to get their paycheck. Interest payable, income tax payable. Okay, there's a thing here. Most liabilities are going to end in payable. The one here that doesn't is unearned revenues. Unearned revenues is a unique one because that is when someone gives us cash and we promise to do work for them or provide a good or a service for them at a later point in time. Okay, it is still something we owe because we've already received the money up front and we still owe some of our time or some of our goods. Okay, and most of the time that is going to be a current liability as well because people aren't going to wait over a year to get that. Long-term liabilities. This is stuff that goes out longer than a year. Stuff we're going to have here is stuff like bonds payable, which we'll learn at the very end of the semester. That's when you're borrowing money from the public, usually large sums of money, but it's usually a 10, 20, 30-year term. And then notes payable, when you borrow money from a bank. Usually, if it's a short term, okay, notes payable can also be a current liability. If it's only 6 months or 9-month borrowing note, you're expected to pay that back within a year, so it can be listed as a current liability. But if it's a 3-year, 5-year note, we're going to list it on our balance sheet as a long-term liability. And then finally, what is equity? Equity is the ownership interest in a company. It's broken down into 2 sections. There's the contributed capital and the retained earnings. Capital is just another, it's the accounting language, the way to say money or cash, okay, or value. Contributed capital is what the owners have put into the business. Okay, so if it's a sole proprietorship or it's a partnership, it's the initial investment or additional investment that the owners take right out of their own personal checking account, or maybe they donate their own vehicle to the business and it now becomes business property. That is stuff that is considered contributed capital because the owners gave it straight to the business. And then Also in the equity section is retained earnings, which is accumulated net income of a company minus the dividends that it is given back to the owners. Because you think everything that happens, all that income that comes in, it actually belongs to the owners. Okay, a lot of times they won't take it all out, they'll leave it in the business as a retained earnings. Next, we're going to talk about preparing a balance sheet. So it's important to note that how we have them listed here are assets. Remember, our classified balance sheet is going to show that accounting equation. So assets equals liability plus stockholders' equity. And if you go from top to bottom, left to right, this is how they're going to be listed. Current assets and then non-current assets. And then we're going to get a total. Okay, then we're going to start all over and we're going to list our current liabilities, long-term liabilities, get a total liabilities, and then we'll list stockholders' equity, contributed capital plus retained earnings to get total equity, and then we'll add our liabilities and equity together. And that amount must equal the total amount that we have for assets. All right, so here, which of the following here is a liability account? Accounts receivable means somebody owes us money. Somebody owes us money, that is an asset to us. Accounts payable, that payable word should ring a bell. Remember, all payables are always liabilities. Only when the sun is an unearned revenue. So your answer here would be B, accounts payable. Okay, long-term investments are definitely an asset also, as are buildings. All those are assets. Skip that sheet. Okay. So our first thing here, we're going to go through a slide here of how to prepare a classified balance sheet. The first thing we need to do is we're going to go through and we're going to determine, we got to identify what kind of accounts we have. Okay. Inventories. Inventories is a current asset. Okay. Land. Land is a long-term asset as part of PP&E. Salaries payable. That is a current liability. Retained earnings here is part of owner's equity. Accounts receivable, that is a current asset. Cash here is also a current asset. Equipment, that is property, plant, and equipment, or part of long-term assets or non-current assets. Accumulated depreciation, kind of a new account we haven't talked about. Accumulated depreciation is linked to PP&E. Okay, it is a contra account of PP&E. It's kind of lowering the value of our PP&E, and we'll talk more about accumulated depreciation when we get into chapter 7, I believe it is, or 6 or 7. Just know that accumulated depreciation here is linked with PP&E, and it actually makes the property, plant, and equipment go down. Accounts payable. Payable should ring a bell. It's a liability. That is a current liability. Common stock. Buying stock makes you owner of a company. So common stock becomes part of equity. Patents. It's something that we own. We own the patent, but we can't touch it. That becomes an intangible asset. And then it said notes payable. And then it tells you on there that it is long-term. So it's a payable long-term. It is a long-term liability. We're going to put these on a balance sheet. We're going to put them in the order that I said. So to make a classified balance sheet, first, step 1, you create your heading. Okay, the heading always contains company's name on top. Okay. Next, you list what financial statements you're making. So we have Hightower Incorporated. Second line, balance sheet. That is the financial statement we're making. Next, you put the date. Okay? This is going to be different than the other statements you're going to see as we get into them. Remember that a balance sheet is a snapshot in time. So we are going to put an exact date. We're going to say, in this case, it's December 31st, and then comma 2020 or 2021, whatever year it is. Okay, you want to put the exact date. We always had a balance sheet with those three things: company name, the financial statement name, in this case, balance sheet, and then the date, which is an exact date for a balance sheet. It has step one, it has assets in the heading up there. Okay, I don't know if I would really consider that a heading. It needs to go there, but it definitely needs to be listed. Because the first thing we're gonna do is list all our assets. So under that asset heading, first we have our current assets. Current assets we list in order of a term called liquidity. Liquidity is how fast they can be converted into cash. And the order of liquidity is listed in your chapter 1 outline when I list all the different types of assets that they have. They're all in liquidity order right there. Okay, so first we would list our cash, then our accounts receivable, then our inventory. So we went through and identified them. Those were our three current assets. Then we add up our total current assets. Next, we move to non-current. We have property, plant, and equipment. So we put a heading for that. We list our land, our equipment, and then that accumulated depreciation has to be subtracted from that amount. And then we get a total property, plant, and equipment. Then we list any other non-current assets that we have, which we had an intangible assets in our patent. Okay, add those all together, and then we get our total assets of $38,800. And that's it for the asset section. Okay. Next, you're going to make a new heading labeled liabilities and stockholders' equity. Okay. And now we're going to start listing these out one by one. Okay. We have our current liabilities, which we identified as accounts payable and salaries payable. You add those together to get total current liabilities. Then we list our long-term liabilities, which we only had one of, notes payable, $8,100. You add those together to get your total liabilities. Next, we look at stockholders' equity. We have two different accounts there. We have our common stock and retained earnings, so we list those. Add those together to get our total stockholders' equity. And then we add the total liabilities plus the total equity together. And you see we get $38,800, which balances with our total assets of $38,800. This is why it's called the balance sheet. And remember, our assets must always, always, always total our liabilities and stockholders' equity. Okay, so there's how we make a balance sheet. Income statement. We kind of talked about these before. Okay. Income statement is going to show the profit or loss for a company over a period of time. It's not a snapshot in time. It's showing activity. It might have happened for a month, might happen for 3 months or a quarter, might happen for 6 months, might happen for a year. Okay. It's going to show all revenues, which again, revenues are the increase in assets or the value received from the sale of products or services provided. It's going to be minus our expenses, the cost of resources used to, cost of business, basically, whatever we used up, spent in order to generate that revenue. Okay, and then there's also gains or losses. Okay, gains or losses come about whenever a company either has to spend money or receives money or some kind of value that's outside its typical scope of business. For example, if we were, a clothing manufacturer, we normally make our money by producing clothes and then selling them. And then we decided to sell a piece of equipment. And we ended up getting a lot more money than what we paid for that piece of equipment. We wouldn't count that as revenue because that wasn't our ordinary course of business. Instead, it would be a gain. Okay, or if we sold it for way less, it would be a loss. Okay, so gains and losses can happen. They do need to go on the income statement. but we differentiate them. There's two different types of income statement formats that we're going to make here. We're going to make a single step and a multi-step. The differences is just kind of how we list things out. They're both going to contain the same information and will come to the same net income. We'll just put them in a little bit different order. So to make a single step income statement, we have some things here. First, we need to, is it a revenue or an expense? Okay. Well, the only revenue that we have on this one is sales revenue. Okay. Another type of revenue we could have service revenue. Okay. Sales revenue, there might be called sales. Most of it is just called sales. Sales revenue from selling goods, service revenue if we were a service provider. Okay. Maybe some stores, some operations businesses do both. They'll have sales revenue and service revenue. But in this case, we only had sales revenue. Everything else here listed is an expense. And well, let me take that back. I missed it. I overlooked it completely because we also have interest income. Okay, so maybe we loaned some money to some people and they've had to pay us interest. Okay. Everything else on here is an expense, and it's all followed by the word expense, except for one, which is cost of goods sold. We're going to talk about cost of goods sold extensively when we get to chapter 6. Cost of goods sold is when we sell some inventory. Okay, whatever we pay for that inventory, we now make it as an expense. Okay, I'll abbreviate that as we go in as COGS, C-O-G-S. The cost of goods sold is the only expense up here that's not listed as an expense. So we're making a single step income statement. We are always going to list our revenues first. Revenues are known as the top line. Have you ever watched a business show or heard some people talk about business and they say, we need to increase our top line? What we're talking about is we need to increase our sales. We need to increase how many services we're providing. We need to increase the amount of money that we're bringing in. Okay. So in this case, we had two revenues. We list our sales revenue and our interest income, add them together, and we get our total revenue. After that, we have expenses. In the single step, we just go through and list all of our expenses together as one, get total expenses. Revenues minus expenses get us to our net income. As you can see, it's double underlined there, which means it's done. This is an accounting way of doing things where they put a double underline underneath something. It means they're done with that part. Okay, they're done with that statement. You see net income is the bottom. That is known as the bottom line. Okay, so when you hear a company or business people or a business show talk about a company needs to improve its bottom line, it means they need to improve their net income. You can improve your net income by either increasing revenues or decreasing costs. Okay. Now let's look at the same problem. Notice we made 4,860 in net income here. Well, let's look at the same thing. I believe it's the exact same numbers, but we're going to do a multi-step income statement. So here we get some different points. One thing that I should have mentioned when I was doing the other one, whether it is a multi-step or a single step income statement, is look at the heading here. We still have the company name at the very top. The second line tells us what statement we're making. In this case, we're making the income statement. Underneath that, it doesn't say December 31st anymore. It says for year ended December 31st. Okay, that's because that income statement is over a period of time. It's telling you this income statement has happened all year, and our year ended on December 31st. Whereas that balance sheet, we just said December 31st because the balance sheet is showing us what we exactly have at this time. The income statement is saying this is what happened for the entire year. When we're doing a multi-step income statement, we break it down a little bit further. Okay, so still our top line is revenue, but we're only going to be put there the revenue that comes from the ordinary course of business. As you notice, the interest income isn't up there anymore because we're not in the business of losing money. Okay, that's a peripheral transaction. We gotta count it as income, but we'll do it a little bit later. So we start with our sales revenue. From our sales revenue, we subtract our cost of goods sold, okay, which is the expense. Those kind of match. If we have sales revenue, we have goods that we had to buy in order to resell them or produce or however we did it. Okay, that number becomes your gross margin. Sometimes you'll know it as gross profit. Very, very, very important number in the business world. Because if you're going to go out and maybe you're going to manage your business somewhere and they're going to offer you a bonus, a lot of times it's going to be off of what is your gross profit. Because as a manager, that's kind of what you can control. Okay. Because cost of goods sold, you're going to find out is not just the cost of inventory. If there's any theft that goes, that's going to go into cost of goods sold. If there's any kind of spoilage, maybe if you're in a grocery store or the food industry, that goes into cost of goods sold. But sales minus cost of goods sold gets us our gross margin or gross profit. And then we put all of our operating expenses. Okay. The other expenses we had that directly related into making this revenue. In this case, salaries. Yes, we got to have salaries. We got to pay salaries, salespeople in order to sell goods. Rent expense, we have to have rent. Okay, in order to have our business. Depreciation expense. Depreciation is the process of expensing out property, plant, and equipment that we have bought. Okay, so that is definitely an operating expense, and we'll get into more of that in chapter 7. And we need insurance in order to operate our business. Okay. Once we get our total operating expenses, we subtract that from our gross profit to get our income from operations. Okay, that's another important number because that's what investors are looking at. The next, we have our other items, interest income and interest expense. They are not considered operating items. They go into the other category. Once we total them up and subtract them out, that's our income before taxes. And then Uncle Sam's going to get his amount there as an income tax expense. Because we're a corporation, we have to pay our own income taxes. And once you subtract that out, we get our net income. So you can see here, the company made $50,600 in sales, which is its revenue. But out of all that revenue, all that money that they brought in, only 4,860 of it becomes net income, which now belongs to the owners. Okay. A lot of people like to use revenue as a big term. They like to talk about Walmart has $2 billion in revenue. That's great, but what is its net income? How much of that is the owners? How much can go back to the shareholders? It's a good slide to look through. I kind of explained it as we were going through, knowing what gross margin is, knowing what income from operation is. Okay. And net profit margin, not really important here. Okay, so we have two missing amounts here. Take a little bit of time while you're still watching here and see if you can figure those out and what goes in there. And which company is better shape economically and what might change your answer. So on our left side here, we have revenues, expenses, and net income. Okay, then you got to kind of stop right there. On the right-hand side, we have our assets, liabilities, and equity. We'll be using our net income formula where revenue minus expenses equal net income. Now on the right-hand side, remember that assets equal liabilities plus equity. Here's how they would fit in there with Brown Enterprises. 92,740 minus 77,900 will show us the 14,840 would be its net income. Okay, when you're given two of these, you should be able to plug it in there, do some simple algebra, and find the rest. Okay, so which company here looks the best to you? Well, the answer here says Cook is probably one of your better companies because look, it made 25,000 in income. It had the highest income. And it has 33,250 in debt. Liabilities, things it owes. Okay. It owes less money than all the other companies, plus it's generating the highest profit. That's probably a sign of a good, strong company. Look, the owners have a large amount too. Okay. Some of that could change though, if you were to see maybe the cash flow statement too, maybe your perspective would change. And they have all this, but they're having cash flow problems. Maybe they're about ready to go and borrow a bunch of money. They don't have cash flows. They have all these assets, but no cash. Okay. You can get a good idea by looking at the income statement and the balance sheet, but you cannot get the full picture unless you're taking all four statements and kind of comparing them together. Okay, running objective 6, preparing a retained earnings statement. Okay, remember retained earnings is accumulating net income minus dividends. So here we have retained earnings on January 1st, retained earnings on December 31st, which actually we shouldn't know yet because that's what we're going to have to calculate. And then our income plus dividends declared. So we take our retained earnings at the beginning of the year. That's how much income we have accumulated so far. We add in our income to it, which was 4860. We subtract out the dividends that are going to be paid out of 3,000 to get our ending retained earnings balance of 11,300. Okay, and that's what moves on to our balance sheet. Can't stress enough, it's important to go in order for making your statements, okay? You show that one side we have a balance sheet that we start with. We can make our income statement, then we make retained earnings, and then we can create a new balance sheet. They all work together in tandem in that way. And finally, the statement of cash flows. I'm not going to talk about them too much because we're going to do cash flows in accounting too. But this is where you have to break down when we talk about operating activities, financing activities, and investing activities. We break those down individually and we show how our cash has changed. Okay. There are 3 key linkages on here. And this is what I was just talking about. Okay. Income statement links the beginning and ending balance sheet numbers through retained earnings. Okay. Where we have a balance sheet, what we have over here, and all this is going to change. Okay, our inventory may go down and our cash may go up when we make a sale. Our accounts receivable goes up if they're going to pay us later. Maybe our supplies go up and our accounts payable go up. Okay, and as they get used, we have a supply expense. We're going to put on there, we're going to lower our supplies. All this stuff, that accounting equation that we're recording and adjusting stuff. All these accounts are going to fluctuate, but as they fluctuate, those fluctuations are going to be shown on the income statement. That income statement is going to change the retained earnings amount, which is going to help us keep our accounting equation in balance. Okay. So here's just another kind of example of the way these go together. Ethics. Ethics are very important in accounting. Ethics is not just following the law, it is doing what is morally right. Okay. As you see, as we're going to go through this class, there's going to be a lot of times where it's going to take professional judgment. Okay. There's a lot of things that can be done in accounting that are unethical. They're not technically illegal, but you're following the letter of the law. Maybe you're recording it a little bit higher, okay? You're estimating stuff. There's going to be something we have to call as bad debt expense. Whenever you sell stuff on account and you get an accounts receivable, then you have to estimate how much of those people you think are not going to pay. Okay, so maybe you have a bunch of information that shows you from the past 10 years that on average 5% of your customers do not pay their bills. But you need to make your income look higher. So you estimate that 10% of your customers aren't going to pay your bills. Okay, so you can create a higher bad debt expense, a higher expense, or yeah, Higher expense creates a lower income. Okay? I don't know why people would do that to create a lower income. Most of the time they would create a higher income, so maybe you only estimate 2% of the people are not going to pay. Okay? That creates a lower expense, which creates a higher income, which can mislead people into wanting to loan you money. And technically you did nothing wrong because by the letter, by GAAP rules, US GAAP, the rules, they say you're allowed to estimate how many people are not going to pay. So that is your estimation. So your estimation misleads people because you're not using all of the data reliably and ethically. All right, so no matter what you're going to do here, you're going to use this information, probably this first chapter here at some point in time. You're going to use a balance sheet if you're going to be in business. You're going to see an income statement, and maybe you have to make some decisions off of it. Okay. So what we want to get you used to in this chapter is kind of a few things. We want to know what accounting is. We want to be able to identify what the purpose of accounting is. Okay. Remember what it was back from our very first slide is we want to identify, measure, record, and communicate financial information about a company for people to make decisions. Okay. Understand who uses this information. For financial accounting, it's going to be investors. For managerial accounting, it's going to be management. Two different types of accounting. That's why you have two different types of introductory classes. What types of financial information? Financing, investing, and operating activities, and we review them. How is the information communicated? That's the last step. So we communicate information through our financial statements. We have our balance sheet, which shows our basic accounting equation that assets equals liabilities plus equity taken at a point in time, where we list them out assets first, followed by liabilities and equity in the proper order. We have our income statement, which shows revenues minus expenses to get our net income or our profit. Then we have our statement of retained earnings, which shows accumulated net income minus dividends. And then the statement of cash flows, which we didn't talk a lot about, which just shows the change in cash in the core period. All those statements, in order to be uniform, follow the same rules that are being made. Those are called US GAAP, the generally accepted accounting principles, which are created by the Financial Accounting Standards Board or the FASB, US only. And then publicly traded companies are regulated by the Securities and Exchange Commission. They make sure that people are following rules. Again, the golden rule of accounting: assets equals liabilities plus equity. We need to be able to identify what is an asset, what is liability, what is equity. Not only that, we need to be able to identify in assets and liabilities the difference between a current and non-current in both, with the difference being whether we're going to use it up, spend it, or pay it back within a year. You need to be able to identify which of our accounts go on which statement. Remember, assets, liabilities, and equity are always on the balance sheet, whereas revenues and expenses are always on our income statement. And that is about it for chapter 1. So be sure to read the chapter, come back, review this video anytime you need to. Free handouts on this chapter. I highly suggest you practice them and go through them. Okay, try to do it without me before you watch the video on it. Try it on your own and then come back and check the videos to make sure that you're able to do it correctly. Okay, thank you for your time. I'll talk to you again soon.